you so much for joining us in today's show. Right, U.S. jobs data. This is going to determine whether the markets decide to have a sharp sell-off, that actually the U.S. economy might risk a double-dip recession, or whether it's a little bit better than we expected. Where do you stand on this?
Well, you have to be very careful of reading too much into a single statistic. We had a positive ISM the other day, which I think was probably a rogue number. So I'm not expecting anything too positive from this. But to say this is a double dip, another recession, we're going to get negative growth again, I think that's to go too far. I think that the economy is bumping along at the low growth rate that many of us who looked closely at the statistics over a year ago predicted, because consumers are excessively leveraged and they just don't want to go out shopping again. It's as simple as that.
Bumping along, and yet there's so much liquidity out there. What's going to happen when actually interest rates go up? Are you confident that we will, not bumble along for 3-4 years?
Well, of course, the nightmare scenario is a Japanese-style one in which interest rates don't tick up because the economy doesn't recover, and you end up with deflationary fears beginning to edge out inflationary fears. I think that's the big question that really most people are grappling with as we come up to the Labor Day weekend. What exactly should we be most worried about? Should we be worried about a revival of inflation? Some parts of the world do worry about that because you've got rising food prices. Emerging markets are going to be talking about inflation.
Are you worried about inflation?
Well, I think in an emerging market context where food prices are clearly heading up, yes. But for the developed world, where food is a much smaller component of consumer price indices, it doesn't seem like such a big risk. And with so much surplus capacity in the economy, so many people out of work, I don't see an inflation risk in the United States or even in the European Union anytime soon.
But do you see a risk of, a recession in the U.S., and how can Europe actually deal with it? I mean, we have huge austerity measures and we're so dependent on the U.S. consumer. Well,
I don't see an actual second recession happening in the United States. It seems to me more likely that we'll just get subprime, low growth. The European story is really interesting because, of course, Germany has bounced back in a way that very few people would have predicted just a few months ago. And I think that's revealing for two reasons. One, it shows that being super Keynesian may not be the key. Remember, the Germans were most skeptical about big deficit stimulus packages. And now they're growing their way out of this in a way which I think most Americans are looking at with envy. And the other point, of course, is the exchange rate is crucial. One reason that Germany is bouncing back is that Germany is an export-led economy, and the weakness of the euro following the sovereign debt crisis really has helped Germany. So it's a very, very complex picture at the moment. One can't actually generalize about the world economy anymore. Parts of it are almost in danger of overheating, obviously China, and others, as I said, are heading into a Japanese-style period of low growth and maybe even deflation.
But Germany has also come under criticism by, some French counterparts in the last couple of months saying, well, because you're growing, but because you're not spending, it doesn't put up in a good position. We are seeing signs that actually Germany is, starting to spend. Are you comforted by this?
Not terribly. I mean, it seems to me both China and Germany have in common a reliance on exports, which means that in some ways their recovery doesn't hugely benefit their trading partners. And what we're seeing is a return of those global imbalances that many people saw as a cause of the crisis. The U.S. trade deficit is once again widening rapidly, and of course particularly its deficit with China. And if you look at the imbalances within Europe, they're coming back in much the way that we saw before the crisis too. So in that sense, I'm not feeling tremendously cheered. If global imbalances caused this crisis, the bad news is they're back.
How back are they? I mean, how bad are they? Because who essentially is going to replace the U.S. consumer in, 2-3 years down the line when we are ready to grow? And what does it mean for Europe? Well,
the slow process, of course, is that the Asian consumer, the Chinese consumer in particular, starts to account for a bigger share of global demand. But I do stress slow because it's not going to happen in even a year. There's a huge differential between what Americans can spend when they go shopping and what the Chinese can spend. And I think the short answer is nothing is going to replace the U.S. consumer in the short term. And the U.S. consumer is not going to suddenly bounce back and be filled with confidence again. You have to remember there are big political storm clouds gathering in the United States at the moment, and that's going to have an important impact on the psychology of American households. I think that's one of the big stories to watch as we head towards November. It now looks as if really the Democrats are going to get hammered in the midterms, and this could be very bad news for the prospects of the Obama presidency.
Now, post-crisis, in our developed world, is it also just going to be a lot easier to fall into recession?
Well, I'm not sure about that. I mean, it seems to me that what we see now is a period of very depressed growth in the developed world, constrained by excessive leverage in household balance sheets. I don't think that's going to change. Remember, there are good things going on in the world which counterbalance the bad things, and the growth of Asia and other emerging markets like Brazil is the plus side of the story. So it's not I think, time to get out the arsenic and plan a suicide.
Neil, thank you so much. Niall Ferguson there. And of course,